We decided to go fire on the same day that I got laid off. Why did you feel confident we could pull the trigger even though we weren't fully prepared?
You're going to like this answer, but I would say I didn't feel confident.
If someone's getting laid off and considering fire, what are the top 3 things they should do in the first month? Hey freedom seekers, welcome back. In early November, I got laid off. On that same day, Tyler and I made the decision to retire early. If you're new here, hi, I'm Angie.
And I'm Tyler, and we spent the last 6 years building financial independence while traveling about 6 months out of each year.
So on this channel, we're sharing all of the unfiltered stories about fire, the actual numbers, the emotional roller coasters, the mistakes, and all the lessons that we learned along the way. Now here's the thing, we are not prepared for fire. Today, I'm sitting down with Tyler to walk us through exactly what he did in those first very critical days of our retirement to set up our finances so that we could retire early with security and confidence and able to sleep at night. We hit our financial freedom just a few months earlier, and then we stuck in this classic one more year syndrome. We kept thinking that why don't we just build a bigger nest egg?
So when Angie's layoff happened, we had to shift our whole financial strategy overnight from wealth accumulation mode to wealth preservation mode.
I shared this in another video about the first month into retirement. For the first few weeks, I was so exhausted. I couldn't bring myself to do anything but playing puzzles. So Tyler actually single-handedly overnight put our finances together so we can actually start our early retirement. So what we're gonna share today, why Tyler felt confidence that we can retire early on the same day that I got laid off, the very first financial moves that Tyler made, the big threats for early retirees, and what we wish we had done differently. Let's get into it. I have 3 pages of questions. So let's talk about the initial shock and decisions. When I woke you up, okay, let me tell the story first. I remember it was on a Wednesday. It was my very first meeting of the day. I talked to my manager and she told me that I got laid off. And then after the call, Tyler was still sleeping. So I ran up to the bedroom and broke the news to him. So when I woke you up that morning with the layoff news, what was going through your mind?
Yeah, I remember opening my eyes and you were looking down at me and you were smiling. And it's very rare that you'll interrupt me and wake me up in the middle of the morning before I'm awake. And you said, Tyler, I have to tell you something. I got laid off. It was kind of like this disconnect between the facial expression and the news. I was sort of trying to process. I think for a split second, I was just like, wait, are you telling me, am I hearing the words right? That it's like bad news that you got laid off, but you're smiling. So there was that initial shock and contrast. My very, very first thought was just like, you deserve a break. We'll assess everything in the next 24, 48 hours or whatever. Yeah.
I can share more on that. The reasons why I was smiling was when we hit our financial freedom a few months earlier, I had a huge psychological shift. So for the longest time, I was really happy and comfortable at my job. I never really questioned about it because it was never an option. I just have to show up at work. When we hit the financial number, all of a sudden, I have options to walk away from my job if I want to. And everything just became like a corporate game. And I feel more and more the desire of just retiring from the job and doing other things that I'm passionate about. So when I had the news, I was thinking to myself, oh wait, am I really released from this job? And that's why when I woke Tyler up, I was smiling. The very first reaction that I had was a relief. All right, next question. We decided to go fire on the same day that I got laid off. Walk me through your thought process. Why did you feel confident we could pull the trigger right then, even though we weren't fully prepared?
You're going to like this answer, but I would say I didn't feel confident. I would say that there should be a little nuance there too, because it's like you never fully pull the trigger and decide like 100%. So I think for you, there was like a binary feeling of, okay, I'm pulling the trigger. I'm out of the job and I'm not planning in the near future to look for another job. While there is that like binary binary moment transition. I think it is also kind of squishy, and it's something that we'll always be reassessing at least once a year, if not once a quarter. What do our finances look with the current withdrawal rate? Constantly double checking on it. Yeah, in that split second moment, I didn't necessarily feel confident. I had to do a more thorough assessment, and it just kind of put like a fire under my ass to read like a shit ton more. I understood the concept of fire and had done some reading before, but at that moment, I went into like a 72, 96 hour frenzy of just like, I got to read everything and ensure that things look reasonably well to commit in the near term.
Yeah, it didn't help either. I was just slouching
No,
around.
I don't think, I think,
I was so excited.
but you helped with so many other things. So yeah.
All right, next, can you explain what you mean by switching from wealth accumulation to wealth preservation? What fundamentally different about how we manage money now?
I think the simplest like one-liner to differentiate the two is when you're in the wealth accumulation phase, market downturns are opportunities. When you're in a wealth preservation phase, they're liabilities. Because if you're just investing and you're just putting money into your account and you have a salary, when the market goes down, great, I can buy stuff at a discount. But when you're in the wealth preservation phase, I guess we'll get into it a little more later, but it can be a tremendous liability if there's a market downturn, especially in the beginning of your starting to pull from the accounts.
So you had direct exposure to the market.
Yeah, you're vulnerable in a way that you weren't before. And then I think like on a really simple level, just emotionally, it's a big shift to, do I have a stream of income coming in or am I now whittling away at this pot? I think it does cause, for most people, you're going to naturally become a bit more frugal. Yeah. I had some experience with in the past because I had worked on startups and building companies where it was pre-income, pre-revenue phase. You do just have a pile and you just have a runway and a burn rate. So very similar math and very similar psychology.
Yeah, I can see that psychological shift when I think in the past, I can just go over the budget a little bit and then my next month income's gonna smooth it out.
Exactly.
And now we have to really stay within the budget in order to make it work. Now we have the direct exposure to market performance because our income depends on it. What specific risk were you most worried about?
So in that initial immediate thing, I feel like I was kind of ignorant to the risks. The fire under me to really research, I became very aware of sequence of returns risk, which is basically if there happens to be a market downturn in the first 5 to 10 years of drawing from your accounts, the 4% that you draw or whatever the percentage is, you can end up depleting it so much because of the downturn, the fundamental capital in it, that then you just don't have enough. Like when the market does return 5 or 10 years later, you don't have enough capital there to compound interest to get you the finish line. So I think that's the major risk that I'm aware of. Yeah.
I see. So if we have, let's say, 100K net worth, and then during the downturn, it dropped 30%, then you would have about 70K. When we withdraw the 4% of the 70K, so we actually withdrew a lot more than we should during a market downturn.
So your starting point is very important. But if the market was really strong for the first 10 years and then drops, you've had such good returns in the early period that you built a bigger pile. And so then you can weather downturns later. Okay. Yeah, there's something about that early window where you're very vulnerable.
So how long is that early window?
What I've heard online is like 5 to 10 years. You might be able to change your withdrawal pattern, shrink your lifestyle a little bit to withdraw less. But most people, I think, aren't going to have enough variation there. They can really weather 10 years, like 2000, 2010, there was effectively almost like a 0% return in the stock market. If you can shrink from 4% withdrawal to like 3.5% withdrawal, can use that for 10 whole years. Most people aren't probably going to be able to. So it's really like you're kind of at the mercy of the market. I found that it's better to kind of structure your whole portfolio in a way that just allows you to tolerate a potential downturn or low returns in your early period.
So you actually made a video explaining why this is a very risky time, early retire.
Yeah.
So I'm going to link that video in the description. If you want to learn more about why now or in the next few months, the next few years would be a really risky time to early retire, you can check out that video. And then back to our questions. In those first few weeks, while I was crushing hard, what was the very first financial thing you tackled?
You're being very self-deprecating because you needed to take a break and it's fine to play puzzles. And so, I was basically reading a lot about that strategic shift. And I did get very nervous of an imminent market crash because that could really really derail us since we were basically 100% in equities because we were just accumulating and we weren't really thinking about. So the very first thing I did was construct the equity glide path. And the video is about that, step-by-step instructions on how to do it.
Make sure you check out the video
Yeah.
to get all of the terms. So
But-
what's it called again? Equity
Yeah.
glide path. What's the general concept?
So the general concept, and this all comes from the blog Early Retirement Now, which is amazing. The basic concept is that you're most vulnerable in those first 10 years. He runs these models in the blog where in the traditional mode, you start transitioning before retirement because the market could crash 5 years. You're on your way there. So you kind of start transitioning from 100% equities to bonds.
But we did.
So we got lucky that it didn't crash, right? It didn't crash right before. So we definitely got lucky there. But so that's why I was immediately transitioning then on that day one. So then you get a certain percentage of bonds and a certain percentage of equities. And the bonds are like the stable asset that's going to weather you through a potential market downturn. And then the strategy is as you're withdrawing, you're only withdrawing from the bond portion and you're slowly shifting. So that's the glide path part of it. So you set like 80 equity, 20% bonds or 60-40, whatever you want to do. And then over the course of the next 5 to 10 years.
So you're withdrawing from the bond
Yeah,
first.
exactly. No matter the condition of the market. I mean, you can do whatever you want, but in his models, it's very kind of algorithmic and just this was doing. But in general, I think it's always so important. Don't try to time the market. Don't sell a bunch of stocks expecting the market to drop. You should just create kind of an algorithm. There are indices that can help us. We're probably going to see returns in this range over the next 5 to 10 years, but that's very different from timing the market.
So that equity glide path pretty much means that you have to move some of your equities into bonds
Exactly.
a few years before you pull the trigger.
Yeah.
So that's just in case there's a market crash,
Yeah,
you don't
exactly.
withdraw so much out of your equities.
Yeah, exactly. There's a graph we can probably show that where you kind of are slowly investing in bonds to your desired ratio. And then at the point of retirement, you've achieved the ratio you want, and then you slowly adjust back to 100% equities. I'm sure there's lots of other strategies. That's one that I found very convincing and wise.
Did you create any guardrails or rules for when we might need to cut spending or even consider going back to work?
Short answer, no.
I think a lot of people are really scared of pulling the trigger, and then the 4% withdrawal rules and also the financial freedom number. But all of those are based on the assumption that you will never make a single penny for the rest of your life. I feel like if anybody's already made their way to financial freedom, it's almost impossible to not make a single penny for the rest of their life because we have that drive in us and then that financial literacy and the grit to really push through a lot of financial challenges.
Yeah, exactly. And I would just add that I think that's good for a withdrawal strategy or for the equity glide path. But I think as many people know that are maybe traveling down this path, there's just so much unknown and it's inevitable that you're going to have probably a higher risk tolerance than the average person. You just never know what markets historically have given this kind of returns that have allowed for 4% withdrawal, but that might not be the case in the next 40, 50 years. So you sort of have to have faith in your resourcefulness and trust and a certain degree of risks that you're comfortable with. But I do think it's going to be like a year by year, quarter by quarter thing where you're just always reassessing and always trying new things.
So this is probably the biggest concern for everyone who's about to go fire. Healthcare costs are huge in early retirement. What did you do about health insurance?
Yeah, I mean, it was kind of like the very, very first task on my mind is understand the strategic chain from wealth accumulation to wealth preservation. And then I feel like as an American, unfortunately, that was like my second biggest concern was healthcare. And a friend of ours, I thought, made a really good point. It sucks because it hinders fire, but it also hinders healthcare in the United States, but it also hinders entrepreneurship. It's hard to leave a job sometimes if you're getting healthcare through that. And he did make the point that, yeah, but on the flip side, a lot of people do have a much higher salary here than they would in Europe or elsewhere in the world. So that is very true. Like you're saying, since it was kind of forced, we hadn't really in advance, we prepared for it. It was a little more like, can this work? Like, let's see what the healthcare scenario is and will this work? In our state, there are state subsidies. So even in 2026, the federal subsidies may end, unfortunately, but our state still does have state subsidies for healthcare. So it is doable for us, but it is something that kind of stinks in the US that you just sort of never know.
It would be a good thing to look into state benefits. So when you're planning for your early retirement, check out states that offer healthcare insurance subsidies and see if there's any potential that you can move to that state. And another thing that affects the subsidies is the income. So in a way, we have to restrict our income to to below the threshold so we can get certain subsidies from the state. So we're going to continue to explore this topic and then share more with you in the future.
And just on that note of geographical arbitrage, a lot of times people think of geographical arbitrage as like international, like you move to Southeast Asia or somewhere in South America or whatever. And that's really cool and that's all good. I like that you say that you can move to another state domestically and also take advantage of geographical arbitrage. Yeah. Just something to think about. Yeah.
Yeah. All right. So how did you feel during those weeks handling all of this alone while I was recovering? Was it overwhelming?
No, I mean, you worked so much for so long. It felt kind of good in a way. It was fun to kind of like have a real drive. It felt very urgent to research, to understand this strategic shift that we've been talking about. So yeah, it was invigorating kind of in a way. And
that's good.
Yeah. Yeah. Like there was a little bit of stress there, but it was overall invigorating. And yeah, and you deserved a break.
What gave you confidence that we were going to be okay?
Yeah. And obviously, like I said, there's always risk, there's always uncertainty, there's always unknown, but people on FIRE are going to be very familiar with the calculators. And if you're new, definitely play around with some of the calculators because a lot of it is math and models based on historical track records of markets and investments. And for sure, the future may be very different from the past, but the past is the data that we have. And more often than not, there is similarity between the future and the past.
We have spider coming down from the ceiling.
So the past is the best predictor we have of the future. It's the only predictor really in a way that we have of the future. So yeah, I would play around with the calculators. And if the math looks good to you and the risk tolerance is sufficient, it seems like people want kind of like a below 10% at least risk of failure. These models, you can be like, okay, this is the amount of money I have. This is how it's invested. This is my withdrawal rate. And then they give you like the percentage that you're going to deplete it to zero by 95 or whatever age you want to set. And I think I want at least a less than 10% risk tolerance. But if it's 9 or 8, I'm okay with that too. Some people want less than 5%. It's up to you. Some people might be okay with less than 25%. You're still 75% likely to make it. It depends on your risk tolerance. But I think looking at just running the math, running the models, and then kind of like trusting our resourcefulness, I don't think it's likely that we're not going to have income over the next decade. Retirement's sometimes a little bit of a misnomer, I think, because most people, I think, in FIRE usually end up doing interesting projects and they're very motivated to get there in the first place. So they end up doing interesting, cool stuff after that often generates income. Yeah.
I also want to point out that the percentage that Tyler mentioned was, so when you run the different models of FIRE, it's usually a probability. It's not a black and white, a specific number that you have to hit. It's usually just if you have this much and then you plug in all the number, it will give you the probability of success, which means do you still have money when you die?
In like a worst case scenario, you're originally from Vietnam, so you can move there for a period of time and radically cut expenses. So if you're resourceful and flexible, we're young enough, I think, that if like 5-10 years down the road, we did need or want to get a job, it's not too late. You do your best to forecast and plan.
And then you plan your life following the ebb and flows of the market.
Exactly. Yeah. Yeah. And just the ebbs and flows of your emotions, everything. And you keep assessing every quarter, every year.
Yeah. It comes down to how much freedom means to you. You always find a way to make it work. But let's wrap it up because you've been sharing a lot. And now I would love some advices for other people like our freedom seekers who are on their way to FIRE or who are debating if they should go FIRE. So the first question is, if someone is getting laid off and considering FIRE, what are the top 3 things they should do in the first month?
I like that. That's a good question. Yeah, I would say is the calculator. Just run the calculator, figure out what your withdrawal rate would be. Because if you're way off, you just kind of can't FIRE without something really dramatic unless you want to move to a radically lower cost of living area. So that'll just give you a very quick benchmark. Is this in the realm of possibility at all? So number 1, the calculator. And then I think if you do the calculator and, your success rate is, if it's like really below 10%, there's a lot of wiggle room there. And maybe you even set like expense higher than you actually are doing every month. Actually, the very first thing I would say is budgeting. I would think if someone's considering FIRE, they're already budgeting. But if you aren't, you got to make sure you did. That's the absolute number 1. You need to know like what your burn rate is.
I want to really emphasize this point. The reason why we have the confidence in our financial freedom numbers, in our withdrawal rate, is just because we've been budgeting for years and we know which range of monthly expenses that we can be comfortable with.
Yeah. And the longer you've been doing it, the more confidence you have in your ability to like stay within that range, right? But yeah, so that's number 1. But assuming you're doing that, then you do the calculator. So then you can see where you are in that. If you're really in a good risk range, then you can go for it. If you're not, then you can consider geographical arbitrage measures or strategies to radically lower your monthly expenses.
So you can see the risk of fire,
Definitely,
meaning
yeah.
that you can just quit your full-time job and then take on a part-time as long as it can sustain your expenses.
Yeah, that's a great point, because I think that the beautiful thing about financial independence is like it's a spectrum kind of. There's barista fire or like coast fire, where it just reduces the demand for income, which can be really liberating. Now maybe you don't need a super high stress 6-figure job or a career, and you can pick up cash here to supplement, so then you can reduce your withdrawal rate to like 2% or something like that. So it's really cool. Yeah, that's a great point. You can strategize in that way. Let's say that you've decided to go forward with fire. You've done all those in the models, the calculator. Then number 2 is what we did. Wealth preservation is much more complex. I still think you shouldn't overthink it. You shouldn't be trading. You shouldn't be trying to time the market, but it is more complex. And so then I would really read up on sequence of return risks. If you haven't already, make sure that you have a glide path. It's 2020, end of 2025 right now. The market valuation is really high. It looks like we aren't going to have good returns over the next 5 to 10 years. So it's really, really important to have.
We are not.
It looks like it. You never know. So it looks like an equity glide path would be really, really important to make sure you're withdrawing from bonds, something like a stable asset. Yeah, a risk parity portfolio, so to speak. Yeah, so that'd be number 2. And then number 3, I guess you got to figure out health insurance.
If you have a spouse and one of you has a job, then you can get the insurance from the other person. And I guess you can take turns.
Yeah, maybe, I don't know, is that quote unquote fire?
Some people say working at Trader Joe's, working at Starbucks also get you health insurance.
That's a really good point. Yeah, like pick up the minimum hours there to get health insurance. I always felt that like work, even at a job like that, which I did work in the past, jobs like that, it's really just the number of hours you work. If it's like 20, I don't know how many hours you need to get health insurance. Maybe it's a lot, but if it's just like 20 hours a week or so, it can actually be kind of fun to get out and socialize a bit with coworkers.
And we're going to cover more on the health insurance topic once we learn more in the future.
Yeah. And I like that point, because sometimes I think people look at fire as like this mountain that's so hard to ascend, but financial independence is a spectrum, and there are all these steps along the way. And just the more financial independence you have, the more leverage you have, the harder it is for an employer to abuse you. It's just such a good liberating thing. And I just don't want people to think, oh, the 4% rule is this Everest that I'm never going to get to. There are all these steps along the way that will make your life better, period.
So there you have it. That's the nuts and bolts of how we transitions our finances from working life to early retirement literally overnight. The biggest takeaway is that start planning a few years before you pull the trigger to fire, because you never know when life will make that decision for you. If you are on the fire journey, share in the comments below where you are in the process, and also let us know if anything that we share is helpful for you, and we will share more about that in the future. And also, if you're curious about my first month into early retirement, you can check out this video. It's a lot of processing. Emotions, energy, life after fire is more, at least in the first month, is more complicated than I expected. And thanks so much for stepping up and protecting us. It means a lot to me. And thanks so much, y'all, for watching.
Keep strolling to freedom.
And we'll see you in the next one. Bye now.